Hello everyone. Let us start with the Unit 5 of the paper Management of Insurance Services. In the Unit 4, we had understood the overall concept of life insurance policies. Now, there is another concept which is very much familiar with all of us, that is group insurance. And in this unit, we will cover the definition and concepts of group insurance. Why is it actually required? We will also understand the important links for the financial institutions. This group insurance concept is very much in focus by the central government. We will also peep into a few briefly the group insurance regulations and the distribution of group insurance, how it is done by the intermediaries. We will also see what are the different types of group insurance products, as well as understand what is group health insurance plan and what is going to be the future of this group insurance. Now, as I told, that group insurance is a type of policy which we might be familiar with, most of us might be familiar with. Suppose any one of us is working in any organization, you might have come across the concept of group insurance. So it is the insurance not done by the individual, as the term implies that group, the insurance is for a particular group. Now it is for a group of people. So here no one individual is going to give the premium. It is the entire group who is going to give the premium. So that is why it is a group insurance. But the entire group is under one single insurance policy. That is the concept of group insurance. So group insurance is a single insurance policy which is given to a group of people who share something in common. Suppose few of us are the employees of one company. Then that means we are the employees of that XYZ company. So we are in connection. Each one of us is in connection with one particular objective or purpose of serving that company. So each person in that particular group should share something in common, like the employees of a company, like it is the members of a cooperative society, or it can be few members of a society which are from the weaker sections. Now here, the individual person is not the policy holder. As we had already discussed about the LIC policy, in case of LIC, life insurance policy, in that case, the individual person was the policy holder. But here, in case of a group insurance, the employer or the organization is the policy holder, not the individual members of the group. So every people in the group will get a coverage without any sort of medical tests, making this type of policy a bit easier and a bit accessible and affordable also. So it is one of the cheaper type of insurance, which is which varies in comparison if we compare to the life insurance policies. And if a particular individual is availing the life insurance, then of course he has to pay a premium which is more. But here, in case of a group insurance, here the policy, the premium becomes much cheaper, because the insurer sells one policy for many people. Like suppose an organization has 100 of working staffs there. So when one policy is targeted for 100 people, so let us assume that each person just have to pay 300 to 500 rupees for as a premium of that policy every month. So that is why when it is in mass, when it caters to the mass number of people, the entire premium gets divided to the number of peoples. So as and when the number of people goes on adding also, it becomes, the premium becomes less. So it builds a loyalty and retention among the employees as they feel protected and valued. So suppose an organization has a policy of group insurance for its employees, then every employee in the organization feels that yes, in case of any sort of mishappening or uncertainty, there is a policy which takes care of the security. So it arouses that trust and loyalty from the employees towards the organization, and the employees also would like to be retained in that organization for a longer period of time. So premiums become more accurate over the time because the insurers use the past claim experience of the group to calculate the future rates. Suppose a new company, the insurance company like Oriental Assurance Company. So if suppose the company approaches the insurance company approaches a particular organization for the group insurance, then while calculating the premium, they will also consider the track record of that particular organization. So that organization should have a good track record of their past claims. Suppose they might not have given such so many of claims. Suppose the claims are very few in number in comparison to the premium what they are paying for all the employees, then obviously that will help in calculating a better premium rate for that particular organization. And this type of policy continues even as members leave. So few members might leave the organization, few new members might join the organization. So it is as and when the people leave, they will be out of the policy. As and when the new members join, they will be inside this group insurance. So this is what is the most important concept of the group insurance. It is done by a single company. Within that company, any employee who is the employee of the organization is availing this group insurance. Now, this classification of group insurance schemes can be of various types. First one is contributory or non-contributory plans. Now, as we discussed here, the policy holder is the company, and there are all the employees of the companies are the beneficiaries of the insurance scheme. So there can be few schemes where the employer of the organization pays the entire premium. So the employees of the company are not liable to pay the premium or of the scheme. Suppose let us say 500 rupees is the premium per employee, and there are 50 employees. So every month the organization or every year the organization will pay 500 into 50. The entire premium amount will be paid by the company. So that is a non-contributory plan, which is in which the policy holder is the organization. The beneficiaries are the group of employees in the organization, and the premium is paid completely by the organization to the insurance company. There are also schemes which are contributory in nature. Like here, partly let us say 500, then 50% or 25, 75%. That means a portion of the premium will be paid by the employees, and the other leftover remaining percentage will be paid by the organization. So that might have been mentioned in the organization policy before the members join the company. Now that also might be optional for the company, like members. Like suppose an employee is joining the organization. So he will be given an option whether you want to go for the insurance schemes or not, group insurance or not. Now, suppose he says yes, then some percentage from his salary, some amount from his salary will be deducted towards the premium of this plan. But if he does not wish to be a part of this group insurance policy, then it is optional. The amount will not be deducted, but he will also not be a beneficiary of this insurance scheme. So that is how the contributory plan operates. There can be also short-term and long-term plans. Like few short-term plans are usually 1 year renewable contracts. That is, it is basically followed in the organization where the group insurance is renewed every year. So now it depends on when there will be more employees, or the premiums also can vary. So short term means it is yearly, every year the group insurance is renewable. And in case of a long term, the scheme is for a long period beyond 1 year, and here in that case a single amount of premium is paid. There is another sort of classification of group insurance scheme, that is pure term insurance assurance versus other contracts. Now, what is this pure term assurance? This is the assurance which gives only the death benefit, no maturity amount or the surrender value. It usually happens in organization like the employees has group insurance. Now, suppose a person dies in some sort of mishappening or accident within the factory while he is working, then in that case the person is going to get the insurance coverage. Or suppose a person has died due to heart attack during his tenure of service in that organization, then only the person is going to get the amount, the sum assured. His dependents will be getting the sum assured after his death. But suppose the person is surviving within that group, the person survives, then no such maturity amount or surrender value will be given. Then there are other contracts, like some contracts also, they might include savings or investment elements. Like there will be contracts where you are going and putting your premium, and that will help the organization in order to provide some sort of activities for the organization. Or there can be certain investment elements in the schemes also, like they are investing in the market and some sort of profits they are going to get. If the market has if the investment has profits, then they will also be shared, that will also be shared by the organization, by the company to the organization, because here the main policy holder is the organization. So when the insurance company is investing the funds received or collected, the insurance premium which is collected in different securities, then of course when there is a profit, that will be in a sharing mode with the organization. There are different other type of group insurance schemes like fund based and link versus non-link products. So linked and non-linked products, that I have just told you about investment funds. But what happens sometimes, the organization might use this group insurance schemes as a utility for their sinking funds. Like suppose they have a policy in order to pay gratuity or a superannuation amount, or suppose leave encashments to the employees. So this type of insurance products can be used as a savings, so that after a particular, suppose a person is moving out of the organization after 10 years, so then he is liable to get his gratuity. So that amount can be given can be availed through these schemes by the savings which that has been done through several years by the several persons. So in that case, they can also avail the money from the insurance company in order to pay the gratuity, or the after retirement, the lump sum amount which the organization is going to give to the employees, or the amount which the employer is going to give as leave encashments. So as in the life insurance schemes, we had understood that it can be also a saving instrument. The policy can also be a saving instrument. Like after you are retired, you can also get that amount as pension in spread over different periods. So similarly here also, the policy holder or the organization can use these schemes in order to give the gratuity amount or the retirement amount, or maybe leave encashments, anything else. Now moving on to the basic definition and concept of group insurance. As you have already understood, the group insurance means that it is one insurance contract, but it covers many people as a single unit. And the key characteristic of that group, since it is a group insurance, so let us define who is that group of people. The group must exist naturally. That means these are not fabricated groups only to avail that insurance. These are groups which are existing naturally. Maybe the employees of the organization, that it is a natural group which is not only created to buy the insurance, so which are existing for a common purpose, and these groups can avail the group insurance from the company. Members should have a common occupation or purpose. That is what we have discussed now. There must be a central administrative body like HR to manage member details and coordinate with the insurer. So now when it is a policy, when the organization is liaising or dealing with the insurance company, suppose the organization has 50 employees. So a person responsible, key person or the HR person has to provide all the details about those persons or employees who are working in the organization to the insurer, so that accordingly, by assessing the employee's age, employees other type of diseases which are attached to different employees, the entire family details, so everything they will get to know, so that they'll be able to finalize what type of or what should be the insurance premium for that particular group insurance policy. One master policy is issued for the entire group. The group should have regular new members so it stays active and doesn't shrink over time. So here what happens, some people might leave the organization, some people might join the organization, so that keeps the group insurance very much active, so that when people goes on leaving the organization and you are left with fewer people, so obviously that will be a burden on the insurance company. So that is why there has to be always when suppose the people leave, there has to be more new people who are joining, or suppose if they don't leave also, there has to be some new people who are joining. A large number of eligible members should join so that risk spreads and the premium remains low. So when more number of people are there in that group, obviously the amount of premium is divided equally among all the persons. So here what happens, the risk is also less when more number of people pay the premium, and again the premium also remain low because there are so many people in that particular group. There is usually a minimum group size. So every type of schemes, they will have a minimum group size. Like for a particular scheme, it is 50 or 100 or 150. So it varies. The scheme, as per the schemes, the group size also will be defined. The group is assessed as a whole of risk, not each person individually. So it is, the risk is assessed as per the entire group, not the risk is not assessed by the insurer, not by taking only the case of one individual person. There is a free cover limit up to this sum assured. Members does not need medical test in any organization. Suppose the sum assured is 5 lakhs. Suppose in case of accidental death, the dependents of that employees will get a sum assured of rupees 5 lakhs. So in that case, suppose in the group insurance policy is done by the company, in that case you need not give any sort of medical details, or there will not be any sort of medical test for those employees. So there is a free cover limit, but this limit also depends on the different types of schemes. Like let us take the example of different schemes which are floated by the government, insurance schemes floated by the government, which is one of the focus of the central government. So when there are different schemes which are floated and it is covering a large mass of the entire economy, so there it is not possible that you have a medical test of all the people available or entire group. So in that case, you have to assess the some of the data of a general public, and then you have to fix what is going to be the premium. So free cover limit works because when many people are covered together, the risk of one unhealthy member is balanced by that group. So that is why there is a term known as free cover limit, because all the 150 employees or 50 employees of the organization will not be unhealthy. There might be one or two persons who are unhealthy and who might have certain uncertain deaths. Now let us discuss what is the difference between an individual insurance and a group insurance. Individual insurance we have already discussed yesterday in the last unit. So regarding in case of a individual insurance, it is the person specific, individual person specific who buys the insurance. But when it is a group insurance, it is the organization or the employer of the organization who buys the policy for the entire group or the employees. You can have two types of policy in the organization. It can be for maybe you have two different categories of people. Suppose you have executive, non-executives, and you have some workers working with you. So you can have different daily wage workers. So you can have different types of policies for different categories also. Now the policy regarding the policy document, here in case of individual insurance, each individual who is having a policy will have a separate policy of his own. But here in case of a group insurance, one common policy will exist for the entire group of people. And there will be a detailed form, and there will be so many personal information questions about the individual person, like it's his family, his lifestyle, his income, his then inheritance, and about his health. All those credentials, all of data and statistics will be given in the detailed form, which is filled up by the individual person himself. But here it is only that the HR person, in case of a group insurance, the HR person will provide the list of the employees with their age to the insurer. And this form is also very simple. They have to just fill up the form and give it to the insurance company. In case of individual insurance, the risk coverage is the sum assured. So in case of individual insurance, when the date matures, the policy date matures, then the person is liable to get the sum assured, individual person. But here it is decided using a formula for the group. Includes a free cover limit, medical test up to a certain, there will be no medical test up to a certain limit. So here you are not going to get any sort of sum assured, but yes, in case of death or accidents, there will be certain riders. In case of accidents, you might be liable to get this much amount. Suppose you are partly disabled, or suppose you are permanently disabled, you will have certain amount of money which you get. Or suppose in case of death, there will be the dependents are liable to get the particular amount. But here in case of individual, it is the sum assured, and it again depends on the type of policy. So if it is completely policy, it is not an endowment policy, then you will not be getting any sort of money if you are surviving beyond your maturity period. But if it is an endowment policy, you are surviving beyond the period of your, like they have assessed a period of death. So if you are surviving till the maturity, then you are going to get the you are also going to get the sum assured. Now a premium of in case of a group insurance is fixed for the entire term. So you have a premium which you have to pay for a particular, maybe every month you are paying a premium, or maybe every quarter you are paying a premium. So the intervals of the premium are fixed, and you are paying a fixed amount of premium in case of a personal insurance. But here the premium also changes every year based on the age mix and claims. Like there are 50 employees in the organization, few employees would have turned 40, few employees would have turned 50 years, few employees will be turning to 60. So it depends, varies on the age groups. Now, if it is 60, obviously more number of employees are into the bracket of 60, then obviously the premium will be a bit higher. So they will assess the different age groups of the employees who are there and then finalize the premium. So premium might change, will be changing every year. And it also happens in terms of health insurance. Now, term of the policy in case of individual insurance ends when the it has been chosen to be ended. Like suppose you have chosen it to be 10 years, 15 years, 20 years, or till the retirement. So the policy will end on the date of retirement. So it is mentioned in that policy. But here it is the policy continues as long as the employer wants that policy to continue. So now employee might join the company, then he is under the coverage of that policy. But when the employees leave the company, then he will not be liable to get the coverage under the policy. Now, if we talk about claim payment in case of individual insurance, money is paid to the nominee of the insured person. In case of claim payment, the insured person is the individual. So now there, if you remember, we have already discussed about the nominee. So the person who is the policy holder has to declare his nominee while filling up the form or at a later stage when he feels that he should add a nominee. So in case the payment or the death of that person who is the policy holder, then the money will be paid to the nominee. Now, in case of a group insurance, money is paid to the employer who passes it to the deceased employee's family. So since the policy holder is the company, so here the claimed money is paid by the insurance company to the employer, to the organization. And the organization in turn pays that amount to the dependents of the employee who has passed away. There are certain administrative costs also incurred. So in case of individual insurance, administrative cost is high because it is catering to the needs of a single person, and each policy is handled separately. But here, since one policy is catering to the need of one particular group, one unit, so here the administrative cost becomes less. So it is divided among different people. So that is why it becomes less. In case of tax benefits, here in individual insurance, the tax benefits go to the individual. But here in case the employer is the policy holder, the tax benefit for both the employers as well as the individual members, because the names of the employees also will be there in that particular group. So it is a tax benefit for the employer also, for the organization, as well as the tax benefit for the individual members of the organization. Now let's move on to the basic need for a group insurance. Now, group insurance protects people from financial losses due to death, illness, or uncertainty. It gives families a financial safety net and supports economic stability by reducing the risk of the individuals. So the group insurance, the need was felt in companies where there were workers who were working in the organization, and during that workplace, suppose they're working during the working hours, there were accidents, suppose there any death happens, or while working in the organization also people had uncertainties or illness or death. So in that case, there was a need which was generated, that yes, the organization can provide certain sort of financial safety to these employees, and they will also be distressed and relaxed, and can also it can be a motivating factor for the employees to work for the organization. And most important benefit is that here premiums are very less. So what makes this group insurance useful? It provides standardized cover for many people under one policy. It offers lower premium when than the individual insurance. It is easier for organization to manage one policy instead of many, and it helps employees to feel secure, valued, and motivated. So these are the basic usefulness of having a group insurance. And when it is one insurance covering to the entire employees, obviously it will be easy to handle one policy. So usually organizations purchase group policies for their people they are responsible for. There are also organizations who offer a group health insurance. That means not only the employees of the organization, but the parents who are dependents on the employees of the organization are also covered in that type of group insurance. So it happens with big reputed companies who can afford to pay. The premium is a bit higher than this, but yes, they also have some sort of health insurance, and which goes on changing, because you have to give the premium goes on changing every year, because it is not only the employee whose age is increasing, but it's also the dependents on the employees whose age are also increasing. So obviously here the premium also varies or changes gradually with the change of age of the employees. Types of groups can be employee groups. So employer buys insurance for the staffs, as we were discussing now. So employers can be given as a reward, retention tool, or motivation booster. So this can create a motivation within the minds of the employees that they are being having the safety or security of their life. It helps create a stress-free, loyal workforce. And it is also, as we have already discussed, that it is useful for gratuity, superannuation funds where payouts amount vary. So this insurance also can be used as a tool where institutions, organizations can save their amount as premiums and can provide gratuity or superannuation funds as and when the people retire, or as and when people leave beyond the dates when they are liable to get their gratuities. There also can be riders. We have discussed about riders in the 4th unit. Riders are like when riders can also be, some conditions can be put where you can get more extra bonus or benefits in that policies, like critical illness. Suppose the person is having disability, permanent disability or temporary disability, then what can be the benefit that the person can get? Suppose the person is having natural death, he will get some assured of his dependents will get some assured. But suppose the person is having accidental death, then maybe he'll get something more. So these are certain riders which can also be included, as we had seen in the life insurance policies. Group insurance, we have discussed, there will be tax benefits for both the employers and the employees of the organization. There can be non-contributory plan. That means entire premium is given by the employer, but in this case, the employees are not getting any tax benefit. It is only the employer who gets the tax benefit. But there can be contributory plan where some percentage is deducted from the salary of the employee towards the premium, and the rest amount is given by the employer. So here in this case, the tax exemption, the tax benefit is also shared by both the employer and employee. So there, this group insurance also can be availed by non-employer groups. Like if we talk about these self-help groups. So this is a community, this is a society where people would like to borrow funds from different banks, and then they are investing their money in some sort of small projects so that they can upgrade themselves, uplift themselves. So such type of groups also can avail this group insurance. So these are non-employer groups. Here the organization is not going to give you not going to get the policy for you. So it is a non-employer group. So it is an informal group. But here they have come together for a common purpose. But it is not that you are an employee of an organization. So they are not an employee of the organization, but they are connected through some common link, like a bank, like a credit card company, or a self-help group, or a cooperative society. So this type of groups or associations, they can also avail the group insurance. But here, what happens? Who will actually avail it? Since there is no organization, then who is going to avail the policy for the group of workers? So in this case, here an individual person is not buying the insurance, but the person who is the group administrator, he is buying a single group policy for all the members. So there it is not a formal group, it is not a formal organization, it is an informal group, but the person who is the administrator of the entire group, he is purchasing the policy for the a single group policy for the other group members. So here the administrator or the head manages the enrollment, the premium collection, claim coordination, and this makes insurance easier and cheaper for the members also. Like supposing members of the self-help group, they have borrowed some amount. Suppose there are 10 members from the self-help group, in the self-help group. So they have borrowed money from the bank. So now they have to repay the amount to the bank, the principal amount along with the interest to the bank. Now there might be some sort of issues with their ventures. So that is why they should have some sort of securities associated with the loans which they have already borrowed from the bank. So in that case, they can go for a group insurance policy also. But that is again administered by a group administrator. So banks often offer group insurance to loan customers to protect themselves from loan default. It borrows, if the borrower dies or becomes permanently disabled, the insurance pays the outstanding loan amount. Now, suppose the borrower is dying, then of course the insurance policy will is liable to pay to the bank, and the bank will be able to recover the loan. So this reduces the bank risks and protects the borrower's family also. After the death, the dependents of the borrower also will not have that stress of repaying the amount to the bank. So this type of insurance is actually helpful for people who are in the weaker sections of the society. So here the premium amount is very less, and these type of schemes are in line with the different types of schemes which are given floated by the government, which are PMSBY and PMJJBY. We'll talk about this in the later slides. So this is accidental insurance. There can be life insurance also. So this is Pradhan Mantri Suraksha Bima Yojana. Bima, as you know, the term is for insurance. So these type of schemes have been floated by the government. It is in focus where the premium amount is very less, and it mainly focus on the upliftment of the people who are actually the weaker sections of the society. So it is a government-backed accidental insurance schemes. So it protects a person only in case of accidents, not if he dies, have a natural death. Only it is in the case of accidents. So any person who is above the age of 18 to 70 years can have this insurance. The premium is only ₹20 per year, and this premium is deducted automatically from his bank account. If the insured person dies in an accident, their family gets ₹2 lakh, only just for a premium of ₹20 per year. It is not per month, it is per year. The family of the person who dies only in accident, not beyond that, only in accident, gets an amount of ₹2 lakh. Now, if the person loses both limbs or eyes, they also get 2 lakhs. It is for full disability. So it is a rider. We were talking about rider. So these are the conditions. If he has full disability, then he'll get 2 lakhs. If they lose one limb, eye, they get 1 lakh, that is partial disability. Only accident related cases are covered in this Pradhan Mantri Suraksha Bima Yojana. So it is not applicable in case of natural death. Similarly, there was another scheme which is floated by the government, that is Pradhan Mantri Jeevan Jyoti Bima Yojana. So this is also a life insurance scheme that covers death due to any reason. It can be accidental, it can be natural. It covers the insurance scheme is for the death. So here anyone who is above 18 to 50 years can join this, and the premium is 330 rupees per year, and which is again it is automatically debited from the bank account. If the insured person dies for any reason, their family gets 2 lakhs, and this is a pure life insurance, and there is no maturity values, no returns. It is only in case the person is dying, then only it will be given, or else if the person exists till lifelong, then he will not get any sort of sum assured, or no maturity amount can be claimed. So these are few type of insurance schemes which have been the focus of the central government. Now let us move on to the important links for financial inclusion. The group insurance activities which we were just discussing of the non-employee groups, those were basically, or the type of schemes that we were just discussing about these government schemes, those are basically towards the weaker sections or the low income groups of the society. So financial inclusion means that we are providing financial services, may it be the bank accounts. We want that each and every person should have a bank account. Each and every person should have insurance or savings bank account. So that means financial services should be made easily available to the different weaker sections of the society or the persons with low income groups. So this sort of thing or activity is very much important, because that will reduce the social and economic inequality that exists in India in a large, the gap is very huge. So it will support a sustainable economic growth, and it will protect the vulnerable groups from financial hardships. So whenever they are going to face any sort of uncertainty, the weaker sections, then of course this type of tools will help them to get over these financial hardships. And it also ensures citizens are included, empowered, and financially secured. So the financial inclusion in India, the evolution was started with the cooperative movement in 1904, and then the banks were nationalized in 1969. Then gradually there were massive expansion of the branches of the banks. And the government's effort nowadays, gradually it is more focus are being given to digital push, like digital payments and all. Every vendor should be acquainted with digital payments, and also that focusing towards digital India is a vision. Skill development, entrepreneurship promotion, and better access to all the financial services. So these are major focus areas which leads the government's focus towards having a Vikasit Bharat, which is the slogan now. And there is another Yojana, which is Pradhan Mantri Jan Dhan Yojana 2014, which is world's largest financial inclusion program, which was offering bank accounts, insurance, and financial access to millions of people. So already so many efforts have been going on towards having more financial inclusion for the weaker sections of the society. The group insurance regulations are again, we have already discussed about IRDAI. It is also regulated by IRDAI. So IRDAI has guidelines to ensure the group insurance is offered fairly, transparently, and only to genuine groups. So like, it is not that any person forms a group and then they avail the insurance. So it has to be scrutinized properly while providing the insurance policies to the different organizations. A group must be made of people connected by a common purpose or activity or goal. The employees of a company can be a group. The employee welfare association can be a group. The card holders of a bank, anyone, the credit card holders. The credit card holders are always more likely to be defaulters. So they can also be the group who can avail the group insurance. The customers of a business where insurance is offered as an add-on, and borrowers of a bank can be the group. Enter all the borrowers of the bank, or suppose the borrowers, you can categorize these type of borrowers can of the bank. It depends on the bank. It can categorize the different types of borrowers and again have a group insurance policy. Members of the professional bodies or societies, these can be the members or a group which has been defined by the IRDAI, who can be covered under a group insurance policy. And in all these groups, here the group leader or the secretary, the manager or president or the company head can arrange insurance on behalf of all these types of groups. So now the key rules which have been laid down is, if insurer is unsure whether a proposal qualifies as a group, they must ask the IRDAI for clarification. Suppose there is any sort of confusion that such type of groups will be able to avail the group insurance policy or not, it has to be asked to the regulatory authorities. Groups cannot be formed only to buy insurance, so they should have a genuine relationship and they should exist for a common purpose. People cannot gather only to take advantage of cheap group rates. So they already exist for a particular purpose in a particular group. Then it is a supportive advantage that they are going for being a member in that group. So members may enter or exit the scheme, but insurance stops when a member leaves unless contribution of benefits is agreed. And for travel insurance, cover starts once the risk is accepted and the premium is paid. So only when any sort of the premium is paid, starts payment by the policy holder, then after that only the insurance coverage starts. On from that particular month only the insurance coverage starts. Now regarding product pricing, each group product must allow a board approved underwriting policy. Each group product must follow a board approved underwriting policy. That means every group product which is being provided by the insurance companies, they have to have a board approved underwriting policy. It's not for the organization, it's for the companies who are providing the group insurance. So they should have a approved underwriting policies which has to be abiding all the rules which are given by IRDAI. That means what should be the number of people within the group, what should be the amount of insurance premium in different types of policies, what should be the commission which is to be given to the intermediaries who are going to sell the group insurance to the different people. So there has to be the entire policies which needs to be approved, board approved. So premium for a group must be based on the objectives like mortality rates, the group size and the risk profile. Insurer cannot fix the rates randomly. Pricing must follow approved underwriting rules. So as we had already discussed that in case a group has around 50 to 100 members, every year you will see the changing, persons who are, the age of the persons are changing. So now they have to assess what is the proportion of the percentage or of the persons who are above 60 years, or how many people are there above 50 years, or any sort of specific disease is there among few people. So all those things has to be assessed while fixing up the premium, and it again varies from year to year with the change in the age of the person. Marketing of group insurance is again done by the insurance agents. So insurance can sell group insurance through licensed insurance agents or licensed intermediaries also, and they work on the basis of commissions, again based on the guidelines of IRDAI. So corporate agents also must undergo an annual compliance audit. Premiums and benefits of each group member must be clearly stated in the policy. So every policy which the insurer gives, all the different things, information which should be there for the employees or the group members should be clearly stated. What should be the premium, when the premium is likely to change, and how many years the policy is for, or the policy is again renewable every year, or whether the premium is going to change every year. So everything will be written in that policy. What are the riders? Group manager cannot change premium or benefits for individuals. So it is when all the person are in a group, every member's premium is same. It is not that one member premium is more. Suppose a person is prone to disease. So it's not that his premium will be more and the person who is a completely young age and is not having any sort of disease, his premium will be less. So every member in the group will have a similar premium, same premium only. Discounts given to the group must benefit the members, not the organizer or the members. So if there is any discount in the premium, suppose they give a discount of 50 rupees in every premium, so discount will also be spread equally. So if it is 500 rupees is the premium and they have given a discount of 50 rupees, so obviously the discount is spread among all the members and every member will be giving a premium of 450 rupees. If it is contributory, then members and organization will give. If it is non-contributory, then the organization will give on behalf of all the members. Any change in premiums or benefits must follow the underwriting rules and the insurer's approval. So there are different group insurance products like 1 year renewable group term. Here a plan where employers give free life insurance to all employees for 1 year. It is free and it is renewed every year. It is non-contributory and the employer is giving all the premium, and the minimum group size here it is defined as 25. Entry age is 8 years to 75 years and renewal allowed till 80 years. So every year the organization goes on renewing and it is free of cost to all the members, all the staffs. So the insurance coverage is only for only in case of death. It may be accidental or a natural death. LIC's 1 year renewable group term plan, it gives yearly renewable life cover at a very low premium. Similarly, group term insurance scheme, this is also employer-employee group or homogeneous groups like doctors, lawyers, bank members, welfare funds or credit societies. This can also be used for creditor-debtor groups, as we were talking that the banks can make group insurance for the credit card holders. It is used by housing societies, banks, cooperatives and institutions giving loans. And this can be LIC's single premium group insurance. It is one-time premium. Here you are not going to renew the insurance every year. It is one-time premium. You are providing the premium for one particular time, and it provides flat life cover during the entire policy term. Entry age is 18 to 60 years for the members and the group size will be 50. There can be group gratuity scheme as we have already discussed. Employers must pay gratuity for every year an employee works. So these schemes helps the employer to make savings so that they can provide the gratuity funds whenever the employee leaves the organization, or suppose they can provide the superannuation amount whenever the employee leaves after retirement. So there can be group superannuation scheme also, a retirement plan giving pension to employees after they retire. So here in case of you go on giving premium through the entire life. After the retirement, the employee will start getting the pensions throughout his life period. So there are different types of schemes that also caters to such type of needs of the organization. There can be grouped savings linked insurance schemes. Here there will be monthly deductions from salary fund insurance plus savings. The part of the contribution is equal to the insurance covers, and remaining part is the savings accumulated with interest until you exit. If the employee dies while in service, insurance amount plus the accumulated savings will be paid to the family. So a part of the salary will be deducted from the account, from the salary of the person. Now suppose let us say 100 rupees is deducted, 50 rupees is therefore is given as the contribution for the insurance, and 50 rupees is their savings account, in the savings account of the company. So when in case the employee dies, then the insurance amount sum assured as well as the accumulated savings of the company by the person with the company, that is also paid at one point of time. So that is known as group savings linked insurance schemes. Group leave encashment schemes also, employees who are accountable to get leave encashments every year. Here also some amount is credited and it is kept as reserves, and employees who are wanting to avail the leave encashments, they will be given the leave encashments from these savings. There are also group health insurance plans. A group health insurance plan gives medical coverage to all the members of the group. As I was discussing, that some companies, they get medical coverage for the employees as well as their dependents, their parents who are also aging. So it is an indemnity plan, meaning that insurer reimburses actual medical expenses as per policy terms. So suppose you have there is a health issue and you have incurred expense of around 10 lakhs, and suppose your policy covers till 10 lakhs or 15 lakhs, then automatically that amount will be reimbursed by the insurance policy company. So it is provided by non-life insurance companies only, and this is a specific insurance sector. Here health insurance only, special insurance, and a standalone health insurers. So New India's universal health insurance group mediclaim policies also exist. So it covers hospitalization expenses for illness or injury for group members and their families. The minimum group size is 100 for the health insurance. Claims are settled via TPA. It is cashless or reimbursed to the insured if paid by them. If the insured has already paid the amount to the hospital, then it will be paid back to the insured. Or in some cases, if the insured has not paid, they will produce the bills and that will be paid to the hospital. So payment is made as per the limit policies and condition. That means if you can avail, if your policy is only for 10 lakhs rupees, then you will get the claim only till rupees 10 lakhs, not beyond that. So now a group insurance claim will be processed. Like a claim, there will be claim intimation, the claim form as well as the documents will be provided along with the discharge form from the hospital. So there will be intimation which can be given by the master policy holder, all the beneficiary or the legal heirs, and the claim form must be signed by the policy holder. So here the role of the group administrator is more important because he is the person who is going to file the claim. And the role of insurer is to review, process the claim and then get it approved once, and then after that the payment is made to the group administrator. Now the future of group insurance, we have already discussed that Government of India is making strong initiatives in order to boost the insurance sector, and especially give providing insurance to the large weaker sections of the society, or those people who are having low income groups. With this, we come to the end of this unit.